Here is something most retail traders overlook. The euro against the pound is one of the most range-bound major crosses in the entire foreign exchange market, yet it routinely catches traders off guard with sharp, news-driven bursts. Why? Because two of the world's most influential central banks, the European Central Bank in Frankfurt and the Bank of England in London, are pulling this single pair in opposite directions almost every week. Today is Friday the 19th of June 2026, and euro to pound sterling is sitting at a fascinating crossroads. In this video, we will walk through exactly where the pair stands, the technical levels that matter right now, and, most importantly, the fundamental reasons behind the move. Whether you trade this cross directly or simply hold euro or sterling exposure, understanding the forces at play here will sharpen the way you read the market. Let us get straight into it. Before we analyze the move, let us be precise about what we are trading. Euro to pound sterling tells you how many British pounds are needed to buy a single euro. When the pair rises, the euro is strengthening or the pound is weakening. When it falls, sterling is gaining ground on the single currency. This is what traders call a cross pair, because neither side is the US dollar, which means it strips out a lot of the dollar noise that dominates pairs like euro to US dollar and pound sterling to US dollar. That makes euro to pound sterling a remarkably clean read on the relative health of two economies that sit right next to each other and trade heavily with one another. The European Union remains the United Kingdom's single largest trading partner, so the relationship between these two currencies is not abstract. It reflects real flows of goods, services, and capital across the English Channel every single day. The single biggest reason euro to pound sterling moves is the gap between the European Central Bank and the Bank of England. Currency markets are obsessed with interest rate differentials, because higher rates tend to attract capital and lift a currency, while lower or falling rates push it down. When the Bank of England sounds more hawkish than the ECB, meaning more inclined to keep rates high to fight inflation, the pound tends to strengthen and euro to pound sterling drifts lower. When the ECB sounds firmer than the Bank of England, the euro gains and the pair pushes higher. The crucial insight for today is that this is rarely about the absolute level of rates. It is about the direction of travel and the tone of the messaging. A single line in a press conference about the pace of future cuts can move this cross more than the headline decision itself. On the sterling side of the equation, the story revolves around UK inflation and how stubbornly it behaves. The Bank of England's mandate is to keep inflation at 2%, and for much of the post-pandemic period it has battled to bring price growth back to that target. Services inflation and wage growth have been the two figures that policymakers watch most closely, because they tend to be stickier than energy or food prices. If UK data shows inflation cooling faster than expected, markets price in earlier and deeper rate cuts, which typically weakens the pound and lifts euro to pound sterling. If inflation proves resilient, traders push back their expectations for cuts, supporting sterling and pressuring the pair lower. The labor market matters here too. A tight jobs market with strong pay settlements gives the Bank of England a reason to stay cautious. Across the channel, the euro's strength or weakness hinges on the eurozone's growth picture and the ECB's response to it. The currency bloc is far from uniform. Germany, traditionally the engine of the region, has wrestled with a sluggish manufacturing sector, while economies in southern Europe have at times shown surprising resilience. The ECB has to set one policy for all of them, which makes its decisions a delicate balancing act. When eurozone inflation eases and growth stalls, the ECB leans towards cutting rates, which softens the euro. When activity surprises to the upside or inflation proves sticky, the bank holds firm. And the euro firms with it. For euro to pound sterling, the key is comparison. It is not whether the eurozone is doing well in isolation, but whether it is outperforming or underperforming the United Kingdom at that moment. Now let us turn to the charts, because price action gives us the cleanest map of where buyers and sellers are fighting. Euro to pound sterling has spent recent years trading within a relatively well-defined band, broadly in the mid-80s, and that history matters because long-standing ranges create powerful psychological levels. Traders watch for the pair to test the upper boundary of its range, where sellers have repeatedly stepped in, and the lower boundary, where buyers have defended. The practical takeaway is to identify the nearest clear support and resistance on your own chart and treat them as decision zones rather than precise lines. A clean break and close beyond a long-respected level, confirmed by rising volume and momentum, is far more meaningful than a brief intraday spike that quickly reverses. Patience around these zones separates disciplined traders from impulsive ones. Beyond raw support and resistance, momentum tools add valuable context to the euro to pound sterling picture. Moving averages, such as the 50-day and 200-day, help define the broader trend. When price trades above them and they slope upward, the bias leans bullish, and when price sits below falling averages, the bias turns bearish. The Relative Strength Index, or RSI, flags when the pair may be overstretched. Readings above 70 suggest the move may be overbought and due a pause, while readings below 30 hint at oversold conditions. The real skill is combining these signals rather than relying on any one in isolation. A bounce off support that lines up with a rising moving average and a turning RSI is a far higher quality setup than a single indicator firing alone. Confirmation across multiple tools is what reduces the odds of being caught in a false signal. Smart traders never look at a chart in isolation, they look at it next to the economic calendar. For euro to pound sterling, the high-impact events to circle are the interest rate decisions and accompanying statements from both the Bank of England and the ECB, alongside UK and eurozone inflation releases, GDP figures and purchasing managers' index surveys. These PMI surveys are particularly useful because they are forward-looking, giving an early read on whether business activity is expanding or contracting. The reason scheduling matters is volatility. The pair can sit quietly for hours and then move sharply in the seconds after a release that beats or misses expectations. If you are trading around these events, you must respect the risk of sudden spikes and widening spreads. Many experienced traders simply step aside in the minutes surrounding a major announcement rather than gamble on the outcome. Currencies do not move on data alone. Broader risk sentiment and politics play a powerful role, especially for the pound, which has historically been sensitive to political headlines. Fiscal announcements, budget statements from the UK Treasury, trade developments between the United Kingdom and the European Union, and shifts in global risk appetite can all ripple through euro to pound sterling. When investors are nervous and seeking safety, flows can move unpredictably between the two currencies depending on which is perceived as the safer bet at that moment. Energy prices are another underrated factor, since both economies import significant energy and price shocks feed straight into inflation expectations. The lesson is to stay aware of the wider backdrop. A technically perfect setup can be overwhelmed in seconds by an unexpected political headline, so context is never optional. So how do you turn all of this analysis into action? The professional approach is to define your scenario in advance. Decide what you expect the pair to do, identify the level that would confirm your view, and equally important, identify the level that would prove you wrong. That second level is where your stop-loss belongs. A common mistake is entering on a hunch without a clear invalidation point, which leaves you holding a losing position far longer than you should. For a range-bound cross like euro to pound sterling, many traders favor buying near established support and selling near established resistance, while trend traders wait for a confirmed breakout. Neither approach is inherently superior. What matters is that you choose one, follow it consistently, and keep a record of your trades so you can learn from both your wins and your losses. No analysis matters if your risk management is weak, and this is where most aspiring traders fail. The foundational rule professionals live by is to risk only a small, fixed percentage of your account on any single trade, often 1 to 2%. This means that even a string of losing trades cannot wipe you out, leaving you in the game long enough for your edge to play out. Position sizing should always be calculated from the distance to your stop-loss, never from how confident you feel. Leverage, while tempting, magnifies losses just as fast as gains, and Euro/GBP's sometimes deceptive calm can lull traders into oversized positions right before a volatile data release. Treat capital preservation as your first job and profit as the byproduct of discipline. The traders who survive years in this market are rarely the boldest, they are the most consistent. Let us bring it all together. Euro to pound sterling on this 19th of June 2026 is ultimately a story of relative strength between the Bank of England and the European Central Bank, played out across inflation data, growth surprises and shifting rate expectations. Watch the well-tested support and resistance zones on your chart, confirm any move with momentum and moving averages, and always cross-reference the economic calendar before you commit. Remember that this cross can sit quietly and then move sharply, so respect event risk and never trade without a defined stop. The single most valuable habit you can build is to wait for confirmation rather than chasing every wobble. If you found this breakdown useful, keep refining your own analysis, stay patient, and let the high-probability setups come to you. Trade the plan, manage the risk, and the results will follow over time.